Hello, this is Mike Swanson. I run the website WallStreetWindow.com. And the odds are that you're watching this video right now because you got an email from me telling you that it's up and ready for you to watch. Now, if you're not on my free email list, go into the description. You'll see a link to join. And after you do, every morning before the opening bell, you get an email from me with links to the top market stories you need to know about for the opening bell and to my market commentary. All free. Just go and subscribe. Now, what I want to talk about in this video is lessons that we can draw and the Federal Reserve has drawn from the 1970s in the financial markets and the economy. We're going to talk about specifically the 1974 bear market and what preceded it, because there's some similarities and some key differences. And I had the 1970s in mind as we began this year. In fact, after the stock market had a big decline in the spring of 2020 with all the shutdowns and the lockdowns, the way I responded to that decline was, as the market came off its highs, it became clear that the selling was going to intensify. I sold everything, so I didn't, didn't get crushed, and then I bought back after the bottom within days. But what I bought strategically positioned myself with the 1970s in mind. The 1970s was marked by high inflation, rising interest rates, and during that decade, the best things to be invested in were not bank stocks, were not technology stocks. At the time, there was something called the Nifty 50 that went into a horrible bear market in 1974, and they were the leading stocks before that bear market, and they never became leaders again. Leadership shifted out of them, and I think we're seeing something like that with the decline of the technology stocks and the NASDAQ. But in the 1970s, it was mining stocks, it was energy stocks, material stocks, commodity-related stocks, and REITs and real estate that were the best things to invest in. There was a boom in real estate that carried on throughout the decade. And so what I did is I put my portfolio in energy stocks, in REITs, in mining stocks, a little bit in some issues overseas, and also bought commodities and gold. And those were all the best things to be positioned in the first 5-6 months of 2022. In the 1970s are the best things to be invested in the entire time. And I do think that will continue to be the story as this decade goes on, even though they have had a substantial price drop from their highs of this year. And that's something we're going to talk about in a minute. But things are not exactly playing out the way they did in the 1970s. There's similarities, and we'll talk about them, but there are differences now emerging that I was not anticipating when this year began. And I don't really think people are taking note of at all in the financial media, but it's important to understand and know that they're happening and then try to figure out where things are going to go from there. It's going to take a lot of work to do it, and we're going to do it together, not all in this one video. I'm going to do follow-up videos because we're going to end up having to look at other things too, and this is a journey we're in together. So let's think about 1974 in that decade, and the Fed has also taken it into consideration too. But here's what I was expecting to happen going into this year, really in early 2021. I thought when the Fed took interest rates down to zero in 2020 and began this massive stimulus, and it was going on all over the world, that this was going to result in an inflationary situation. You see, the inflation of the 1970s was really linked to huge deficit spending in the United States and a decline in the value of the US dollar. President Nixon had to take the dollar off of the gold standard because foreigners were selling dollars and repatriating the gold out of the United States. What happened was the Vietnam War, the Lyndon Johnson guns and butter policies created massive deficit spending. There was some inflation was low until really 1968, below 2%, much like we have seen since 1994, downtrend of inflation until last year. That was the story too, until 1968, and inflation got up to 6%. The Federal Reserve raised rates, beat it back down to around 3%, but that didn't stop the deficit spending. And the foreigners, especially in Europe, began to call in buy the gold from out of the U.S. coffers. And Nixon put an end to that. But that decision to put an end to that caused the dollar to go down and help contribute to the first surge in inflation circled on this chart, which took place in 1973. Inflation went over 10%. And the next year, after the start of I was expecting in the first quarter of last year that inflation would take off and would not be transitory, despite the predictions of Jerome Powell, despite claims of really the bull guru leaders, such as, like, say, Kathy Wood, but they're widespread. The Biden administration was claiming inflation would be transitory. By the fall, it did not go away. The fall of 2021 did not go away as they predicted, and it continued to go higher and higher, and it's still been going higher and higher. Hopefully, it has reached a short-term peak in acceleration, but the predictions all are wrong. But what was more important to me wasn't, oh, I want to be right and these people wrong. It was the implications of it. And I saw the 1970s as a model to help try to navigate the years to come. And in 1973 was the start of the inflation takeoff of the 1970s. And 1973, in the first quarter of that year, yes, people saw inflation in 68, in 69, so forth. But what happened in 1973 was shocking. Basically, within a 6-week period, in the first quarter of that year, the prices of meat, eggs, all sorts of grocery items doubled overnight. Some, such as meat, went up more than 100% within this window of time. And it was shocking to people. And by coincidence or not, in April of 1973, it saw the debut of what was one of the most famous movies of the 1970s, Soylent Green. It came out April the 19th, just as this inflation shock hit everybody. And what the movie was about was overpopulation, and this was a global disaster, ecological dystopia that was causing food prices to go sky high, food shortages. In the movie, people really can't get meat, and they're trying to create a substitute food, which is called Soylent Green. If you haven't seen the movie, watch it. It's entertaining, but it perfectly fit the events people were living in, and that is perhaps one of the reasons it became such a big hit. Now, I'm including in a link a report done that you see right here, done by the Federal Reserve itself, studying the year 1973 and the impacts of inflation and how this all played out. The statistical data is all here in this 13-page research report, but I just want to draw you attention to one little comment. At the beginning of inflation was at 3.2% annualized from 71 to late 72. And at the beginning of 73, a few people were the President's Council of Economic Advisors were actually anticipating and predicting a decline in inflation, which doesn't that sound so familiar as the claims of transitory made in 2021? And yes, in 73, early and going into that year, there were some economists that did think inflation could pick up. There were forecasts for that, but no one really predicted the shock that inflation that year actually became. And the problem with inflation is the only way to beat it back down is to raise interest rates. And the Federal Reserve so went out towards the end of that year and in 74 on a rate hiking cycle, taking rates above, I think they got up to 6% or right below it. And as you can see, the inflation rate itself dropped back down to around 6%, where they got the rate hikes to go to. Now, 1974 there was an epic bear market that started in 73, carried over for about roughly a year, started in the summer of 1973, as these rate hikes happened. Now, gold continued higher, unlike the stock market in this bear market. So I didn't really think too much about this specific bear market when this year started. Frankly, I thought the market might just go into a bear market, but might be like some of the ones I'd been through, where you get a 20% decline, then a panic sell-off and a big rally, and you know, it ends up at the end you're down 30% or something. But as the months have gone by, I have more and more considered it very likely that we could be going through a bear market in some form or fashion similar to the 73 and 74 bear market. And if you look at it, here's how it played out. It didn't have the mega rallies. It just kind of went down, down, down with a 50% decline. Now, nothing is going to play out exactly the same, and there are some differences now happening, but there is a risk that the stock market falls down towards its lows of 2020, because we are in a rate hiking cycle. There has been so far no signs of panic, as I mentioned in the last video about how to use the VIX to signal bottoms. It hasn't given a signal. And go to the last video about this topic. I did, and you'll see that. But you know, if we play out, this market continues in the downtrend it's in, you can draw two trend lines, a downtrend channel, then if it's similar to that 73, 74 thing, we're going down to like 3,000 by the end of the year, and could go lower. You know, a year from now, or fall of 2023, potentially, you're then looking at the lows of 2020 if the market simply continues to trade as it's been doing in a downtrend channel without a true panic washout. Now we get a panic washout this fall, then that scenario would not play out. But I think it's important to be flexible in your opinions on the market and the different trends and things that can happen here. But here's the thing about this 1970s, and what I did not anticipate is that the Federal Reserve would look at the scenario of the 1970s too, and factor that in its decision making. So, in my view, going into this year, I thought, okay, the logical thing is we're going to have a bear market. We're in the first rate hiking cycle, and the bear market will happen, and then we'll play out like the 1970s. So after the towards the end of this 74, near the bottom in 74, the Federal Reserve actually began to lower interest rates. The U.S. economy went into a recession. The rate of inflation basically annualized went down 50%. And the Fed not only stopped raising, but they began to lower rates. And as you can see, the stock market then bounced back up. Wasn't an incredible bull market like the 90s or something, but it bounced back up. 77, it stalled out, didn't do anything for really 3 years, but it was a significant bottom in 74. And a great buying opportunity. I do think we will see another great buying opportunity, and I'm going to be very excited to when it happens. But the thing is, inflation did not end in 1974. Inflation, as you can see, continued higher and got worse, and the Fed had to take interest rates up even more. And there was an even bigger recession around 1980, 81 as a result. And the official policy name in 1974 that the Fed gave to, okay, we're now going to stop raising and actually do a few cuts, is stop and go. The idea was we're going to stop inflation by raising rates. When the inflation comes back down, we will then go and turn on the economy by lowering rates. I thought this could be what we're headed for. But what happened was in June, and I wrote about this in a July 6 update, and barely a word about it in the financial media, much less on YouTube with other commentators, because people really are not focused on these big picture issues. They want picks, they want trades. This type of big picture analysis not as popular, doesn't drive television ratings, but it's so important to understand what's going on. So the Fed said, Jerome Powell gave 2 speeches, one overseas, one to Congress, in which he made some comments. Other Fed officials made comments to the Wall Street Journal. And I linked to a couple Wall Street Journal articles talking about what they were saying and why it's so important. But basically, they said that Jerome Powell said, and a couple of these other people, look, the Fed in 1974 made a mistake when they lowered rates. The experience of 73 ingrained the idea in people's minds that inflation is a big problem. It's going to continue, and that helped drive a self-fulfilling prophecy. And when they lowered rates in 74, it was a huge mistake. So he basically makes the argument that we don't want to do that again. We are willing to we want to hold off basically the next rate cut for as long as possible in order to not just get inflation down, but to hopefully get people's inflationary mentality, fear of inflation, away too. we want inflation. We don't want to repeat the 1970s. Well, that has huge implications for the stock market and is probably the big reason why we're seeing now lately the pullback in gold and silver and precious metals that we've been seeing, and other commodities too. And frankly, I'm not sure if that's going to work for the Fed. I'm not sure how this is truly going to be playing out as we go to the end of the year. Now, nothing at the moment is really going to change. More Fed rate hikes are coming this summer, this fall. The predictions many have made that, the Fed will raise in July and stop, because we have been used to the so-called Fed put, that whenever the stock market drops, the Fed cuts. They're saying we're not doing that anymore because inflation is now a bigger problem than a stock market decline. Inflation is impacting real Americans. It's hurting business people. It's making it difficult to hire workers. It's making it difficult to expand businesses. It's more costly for the real economy to have inflation at 9% than it is to have the S&P 500 fall 20%. And that's why the Fed, rightfully so, is now more focused on the dangers of inflation and stopping it, the inflationary mentality, than stock market declines. The problem is nobody can really predict how this is going to play out over the next year. Let's say Jerome Powell, the Fed has a target now of like 3.5% on the Fed funds rate. Let's say they get there by the end of the year, and then they do not raise rates at all in 2023, which is what Jerome Powell is basically saying in the past 2 months. In the articles and interviews people are paying attention to, that's what he wants to do, to beat back inflation, not just push it back temporarily like they did in 74, but beat it down like the Fed had done a couple of times way before the 1970s. I'm talking about 1947. I'm talking about 1921, and an attempt to do that in 1929. Well, if the Fed succeeds at that, then my scenario that's guided my investing for the past 2 years, that we're essentially having a repeat of the 1970s for the next decade, is not really going to play out the way I thought it would. There'll be a great buy point in gold and commodities and energy, but it won't play out the same as it did in the 70s. But what if the Fed fails? What if the Fed cannot hold off on rate hikes because the stock market falls too much and it damages the economy so much that the Fed has to respond to that and then lower rates? What happens then? Lots of questions, no way to exactly predict it. But I think one of the things I want to do with you in some follow-up videos soon is look at these past cycles where the Fed was successful, and a cycle not different than the 70s, where they completely failed at this attempt that they're trying to do now, and why it failed and what happened. So we want to learn from history. Nothing repeats exactly the same, but if we know the different ways things can go, if we know the different paths, the different possibilities head to, we can kind of know where we're headed to when the next turn takes place, and adapt, adjust, always be ahead. So that's what we're going to do. Trying to think if there's something else I wanted to tell you. just one thing I do want to repeat is is very important. Look, in the video I did about the VIX, I explained showed how the VIX is very important for me in timing market bottoms, but the VIX is trading in a way that it's never traded before in my years of trading since the 1990s. The S&P fell 20% and the VIX has not signaled panic. The stock market has fallen for 6 months and we've not had a panic washout. That's pretty something that's never happened before in my years of trading, and probably not yours or anyone else's that's watching this video. So we're in a different market environment than any of us have seen before. That demands understanding and looking for comparisons to help us understand what in the world is going on here. Because blind buying is not the answer. When the S&P falls 20% and there's no panic washout, blind buying and just throw more money and more money every week at it, it's not a good strategy. If current conditions continue and there's no panic washout this year, you're looking at a bear market that's going to go on through next year. Significantly lower prices than we are now without that panic washout. We get the panic washout, we can buy, but buy knowing that it's safe to buy. It takes patience, but it doesn't mean doing nothing. It means watching the situation, looking for lessons from the past, applying them what's going on. So if you like this content, hit the like button. And if you're new, hit subscribe, hit the bell, and then YouTube will send you an alert as soon as my next video is up and for you to watch. Be talking with you later.